What is the Darvas Box? The Darvas Box is not just a trading concept. It is a reflection of market psychology in its rawest form. Every trader who has been through enough cycles understands that markets do not always move because of logic or fundamentals. More often, they move because of fear, greed, hesitation, and exhaustion. The Darvas Box captures that precise moment when all of these emotions collide and neutralize each other. In simple terms, the Darvas Box represents a period of balance between buyers and sellers. Neither side is strong enough to push the price beyond a certain threshold. Price becomes trapped within a clear and visible range. There is no new high. There is no new low. The market simply drifts sideways as both sides quietly reassess their positions. To the untrained eye, it looks like nothing is happening. But to those with experience, it signals a crucial moment of buildup. Behind every box is a story of trapped liquidity. Institutional players do not rush. They operate patiently, accumulating or distributing within these boxes without revealing their true intentions. This process leaves footprints. Price action becomes compressed. Volatility fades. Volume dries up. These are not random occurrences. They are calculated moves by those who understand that time often shakes out the weak hands before price does. Trading is not about predicting the future. It is about recognizing recurring patterns of human behavior through price. The Darvas Box is one of the purest examples of this. It shows the market in a state of indecision, yet quietly preparing for its next aggressive move. Whether the breakout is real or false is not as important as understanding why the box formed in the first place. For the experienced trader, the Darvas Box is a tool of patience. It forces you to wait, to observe, and to respect the market's rhythm. Those who rush in too early will often find themselves on the wrong side of a false breakout, stopped out by the very players they hope to follow. Those who understand the psychology behind the box recognize that timing is everything. Markets are driven by liquidity, not opinions. The Darvas Box serves as a map highlighting where liquidity is being quietly stacked. Once the accumulation or distribution phase is complete, the breakout becomes inevitable. This is not guesswork. It is the nature of how financial markets operate when supply and demand reach an imbalance. Professional traders do not chase prices. They wait for clarity. They position themselves where risk is smallest and potential reward is largest. The Darvas Box offers exactly that. It provides a framework to interpret when the market is quietly loading its next big move, allowing you to step in with confidence rather than hope. In the end, trading is not about finding magic setups. It is about understanding where money is moving, how fear and greed are playing out, and how patience can turn uncertainty into opportunity. The Darvas Box is nothing more and nothing less than the visible manifestation of these timeless truths. Characteristics of the Darvas Box. Recognizing the Darvas Box on a price chart is not merely a matter of drawing horizontal lines around a range of prices. It is about understanding the deeper message behind the structure. Financial markets are driven by human psychology, and every box that forms on the chart tells a unique story of uncertainty, hesitation, and ultimately preparation for a larger move. Traders who understand the characteristics of the Darvas Box do not just see consolidation. They see opportunity quietly taking shape beneath the surface of the market. The Darvas Box often emerges after a strong directional move. Price reaches a temporary equilibrium where buyers and sellers agree on a fair value, at least for the time being. This agreement does not last forever. Over time, the market either resumes its previous direction or reverses entirely. However, during the formation of the box, certain traits consistently appear. Recognizing these traits allows traders to prepare, plan, and position themselves for what comes next. The first and most obvious characteristic of a Darvas Box is its clearly defined horizontal boundaries. These are established by multiple touches of price at both the upper and lower limits. The more times price respects these boundaries without breaking through, the more valid and reliable the box becomes. These repeated tests indicate that both buyers and sellers are defending their territory with conviction. Sellers refuse to allow price above a certain level, while buyers step in to protect the lower edge. The stalemate continues until one side finally exhausts the other. Within the box, price action typically becomes compressed. The wide, volatile swings that often characterize trending markets give way to narrower, more subdued movements. Candlesticks grow smaller. Ranges contract. This is a visual representation of indecision. Neither side is willing to commit large orders, and as a result, volatility decreases. Markets breathe through expansion and contraction, and the Darvas box represents the contraction phase of this cycle. Volume often mirrors this contraction. During the formation of a healthy Darvas box, trading volume tends to diminish. This is not always the case, but it is a common feature. Lower volume reflects a lack of enthusiasm from both buyers and sellers. Institutional players are not yet ready to reveal their hand. Retail traders grow bored or frustrated, often exiting positions or reducing size. This thinning of volume sets the stage for a sharp increase once a breakout occurs, as pent-up energy is finally released. Another defining feature of the Darvas box is time. Boxes that form quickly, with only a few touches of support and resistance, are generally less reliable than those that persist over a longer period. The longer the market trades within the box, the more significant the breakout tends to be. This is because prolonged consolidation represents a more substantial buildup of orders on both sides. When the breakout finally comes, it clears out this accumulated liquidity, often resulting in a decisive and swift move. The psychology behind this is simple. Markets operate on supply and demand, but supply and demand are not static. They evolve as traders adjust their positions, as news flows, and as sentiment shifts. During the life of the Darvas box, market participants grow increasingly polarized. Some grow confident the box will break to the upside, others bet on a breakdown. Both sides place orders, creating a pool of liquidity above and below the box. When price finally breaks out, it triggers these orders, adding fuel to the move. Inside the box, false breakouts are common. These occur when price briefly moves beyond the established boundaries, only to reverse and return within the range. False breakouts serve a purpose. They test the resolve of participants, shake out weak hands, and gather liquidity for larger players. Recognizing a false breakout requires experience and the ability to read price action with nuance. Volume spikes without follow-through, wicks on candlesticks that quickly retreat, and a failure to hold beyond key levels are all clues. It is also worth noting where the Darvas box forms in relation to the broader market structure. A box forming at the top of a strong uptrend may signal distribution, where smart money unloads positions to less informed participants. Conversely, a box at the bottom of a prolonged downtrend might indicate accumulation, as value buyers quietly build positions. Boxes that form in the middle of a range-bound market are often less meaningful, as they may simply reflect ongoing indecision rather than preparation for a significant move. Market context matters. A Darvas box on a higher time frame carries more weight than one on a lower time frame. Weekly and daily boxes often lead to larger moves than those on the hourly or minute charts. This is because higher timeframes capture the behavior of larger market participants whose actions influence price more significantly. Understanding this hierarchy helps traders prioritize which boxes are worth their attention and which are best ignored. Beyond the technical aspects, the Darvas box teaches traders about patience and discipline. Trading within the box is often frustrating. Price seems to go nowhere. Breakouts fail. Momentum dries up. Yet this is precisely when the seeds of the next big move are being planted. Traders who chase every minor fluctuation within the box often end up with small losses or missed opportunities. Those who wait for clear confirmation and respect the boundaries of the structure position themselves for higher probability trades. Risk management is another area where the characteristics of the Darvas box prove valuable. The clearly defined support and resistance levels provide natural areas for placing stop losses. These levels are logical because they mark the points where the balance between buyers and sellers shifts. Exiting a trade beyond these boundaries acknowledges that the market has changed character, and the initial premise for the trade is no longer valid. Targets can also be derived from the box itself. A common approach is to project the height of the box from the breakout point to establish a minimum target. This projection is not arbitrary. It reflects the distance price was willing to travel within the confines of the box, suggesting a similar move is possible once the boundaries are broken. Combined with proper risk management, this method offers a structured approach to setting expectations. In conclusion, recognizing the Darvas box is about more than drawing shapes on a chart. It requires an understanding of market psychology, patience to wait for confirmation, and the discipline to execute a well-planned strategy. The box reflects a battle between opposing forces, a buildup of energy, and the eventual release of that energy in the form of a breakout. Traders who master the ability to identify and interpret these characteristics position themselves ahead of the crowd, ready to capitalize when the market finally reveals its hand. How to trade the Darvas box. Trading the Darvas box is not about reacting to random price movement. It is about understanding structure, psychology, and timing. The Darvas box represents a battle between buyers and sellers, where neither side is willing to concede. Price is locked within a tight range, creating clear support and resistance levels. The true opportunity comes not from trading inside the box, but from understanding how to trade when the box completes its function and the market is ready to move. Successful traders approach the Darvas box with a structured, methodical process rooted in patience and discipline. There are several core strategies, and each requires a deep understanding of how price behaves at the edge of equilibrium. Step 1. Identify a valid Darvas box. Before you can trade a Darvas box, you must correctly identify one. This requires more than simply spotting a sideways market. A valid Darvas box has clear, well-tested boundaries. Price should have touched the upper and lower limits multiple times without breaking through. Ideally, the box forms after an impulsive move where the market pauses to digest prior gains or losses. The best boxes are those with clean, obvious boundaries that most participants can agree upon. These levels often become self-fulfilling as stop orders accumulate around them. The box should show reduced volatility with smaller candles and decreasing volume, signaling indecision and lack of momentum. Time frame matters. Boxes on higher time frames, such as daily or 4-hour charts, carry more significance because they reflect the actions of larger market participants. However, Darvas boxes can also appear on lower time frames and offer valuable opportunities if traded with precision. Step 2. Prepare for multiple scenarios. A Darvas box offers opportunities in both breakout and reversal strategies. A disciplined trader must prepare for both outcomes without bias. The market does not care about your expectations. It cares about liquidity. Your job is to observe and react based on evidence, not prediction. Breakout trading strategy. The most common way to trade the Darvas box is to wait for a confirmed breakout. This approach seeks to capture the momentum that follows when price finally escapes the boundaries of the box and triggers stop orders on either side. Entry rules for breakout trading. One method is to place pending buy stop and sell stop orders just beyond the box's boundaries. For example, place a buy stop a few points above the upper resistance and a sell stop a few points below the lower support. This ensures you are only triggered into the market when price shows clear intent to break free. More cautious traders may prefer to wait for a candle to close decisively outside the box before entering. This reduces the risk of false breakouts, but may cause you to miss part of the move. Confirmation can come from factors such as an increase in volume, strong momentum candles, or a retest of the broken boundary holding as new support or resistance. Stop loss placement. Stop losses should be placed just inside the opposite edge of the box. For a long trade on an upside breakout, the stop would go just below the lower support of the box. For a short trade on a downside breakout, the stop would be set just above the upper resistance. This placement acknowledges that a return inside the box invalidates the breakout thesis. Take profit targets. Targets can be set using the measured move technique. Measure the height of the box from support to resistance and project that distance from the breakout point. For example, if the box spans 50 points, the initial target would be 50 points beyond the breakout. This method provides logical, symmetrical targets tied to the structure of the market. Alternatively, traders can use key support or resistance levels on higher time frames as profit targets. Trailing stops can also lock in profits as the trade develops. Fake breakout reversal strategy. False breakouts are common around Darvas boxes because large players often manipulate price to trigger stop orders and gather liquidity before reversing the market. Recognizing and trading these traps requires experience and precision. Entry rules for reversal trading. When price breaks out of the box but quickly returns inside, leaving a long wick or failed breakout candle, it signals weakness. A reversal trade can be taken in the opposite direction of the breakout once price closes firmly back within the box boundaries. For example, if price breaks above resistance but quickly falls back below it and closes inside the box, this is a bearish signal. A short trade can be entered with a stop loss just above the high of the false breakout. The same logic applies for downside traps reversing upward. Stop loss placement. Stops should be placed beyond the extreme of the false breakout. This ensures the trade is protected if price attempts another breakout in the same direction. Take profit targets. Targets can be set at the opposite boundary of the box, as price often traverses the entire range after a failed breakout. Additional targets may align with prior swing points or key levels beyond the box. Step 3. Context matters. The success of trading the Darvas box increases when it aligns with broader market context. A breakout from a box that forms at the end of a prolonged trend may signal exhaustion and reversal. A breakout after a steady uptrend may suggest continuation. Observing higher time frame structure helps clarify the probable outcome. Look for confluence with moving averages, trend lines, Fibonacci levels, or key horizontal support and resistance zones. When the breakout direction aligns with the dominant market trend or higher time frame momentum, the probability of success increases. Volume analysis also provides context. A breakout accompanied by surging volume suggests conviction and increases the likelihood of follow-through. A breakout on weak volume warrants caution. Step 4. Risk management. Trading the Darvas box demands strict risk control. The temptation to overleverage due to the perceived clarity of the box is a common mistake. However, false breakouts, whipsaws, and reversals are part of the game. Risk no more than a small percentage of capital on any single trade, typically between 1 and 2%. Use position sizing to ensure that stop-loss distance aligns with risk tolerance. Accept that not every box will produce a profitable breakout. Trading is a numbers game where consistency and discipline trump short-term outcomes. Step 5. Psychological readiness. Perhaps the most overlooked aspect of trading the Darvas box is the mental discipline required. Boxes often test patience. Price can remain range-bound longer than expected, leading to frustration and impulsive trades. The disciplined trader waits, observes, and acts only when clear conditions are met. Emotional control is essential during false breakouts. Fear of missing out often leads traders to chase moves without confirmation, only to be trapped in reversals. The professional approach is to remain detached, treat each setup independently, and execute according to plan. Practical example of trading the Darvas box. Imagine a currency pair trading between 1.2000 and 1.2050 for several sessions. Price repeatedly tests both boundaries without success. Volume declines, candles grow smaller. A trader identifies this as a valid Darvas box. The trader sets a buy stop at 1.2055 and a sell stop at 1.1995. A decisive breakout occurs to the upside with strong volume and a large bullish candle closing above 1.2055. The trader enters long, sets a stop at 1.1990, and targets 1.2100 based on the box's 50-point height. Alternatively, if price had broken down but swiftly reversed, closing back inside the box, the trader might take a long position targeting the upper boundary, recognizing the breakdown as a trap. Final thoughts. Trading the Darvas box is deceptively simple, but requires patience, discipline, and understanding of market psychology. It is not about predicting the future, but positioning for high-probability outcomes based on structure. Breakouts provide momentum opportunities, while false breakouts offer contrarian setups. Context, volume, and confirmation increase the odds of success. Professionals use the Darvas box because it offers clear risk parameters, logical targets, and insights into the behavior of market participants. Those who master this method gain not only a technical edge, but a psychological one, learning to wait for the market to reveal its hand before committing capital. Ultimately, trading is a game of probabilities, patience, and process. The Darvas Box embodies all three, making it an essential tool in the arsenal of any serious trader seeking consistency and longevity in the financial markets. Why the Darvas Box is effective. The effectiveness of the Darvas Box in trading does not come from magic or luck. It comes from its ability to visually capture the psychological equilibrium between buyers and sellers before a significant move occurs. At its core, the Darvas Box reflects the natural behavior of financial markets. Phases of movement followed by phases of rest, of expansion followed by contraction. Markets, much like people, do not move in straight lines forever. They need time to pause, gather energy, and prepare for the next phase. The Darvas Box embodies this preparation. The psychology behind the Darvas Box. To understand why the Darvas Box works, you must first understand the psychology behind price consolidation. When price enters a box, it is a sign that neither buyers nor sellers currently have enough conviction or strength to push the market in one direction. Buyers are hesitant to chase higher prices without confirmation. Sellers are cautious about pushing the market lower without clear evidence of weakness. Both sides retreat, and price oscillates within a defined range. This standoff creates visible support and resistance levels. As more traders notice these levels, they begin placing orders around them. Stop losses just beyond the boundaries, breakout orders just outside. Liquidity pools start forming above and below the box. Institutions and professional traders are keenly aware of this. They understand that once these boundaries are breached, a cascade of orders will follow, propelling the market swiftly in one direction. What makes the Darvas Box powerful is this buildup of tension. The longer the consolidation, the more participants commit to positions within the box, and the greater the potential energy when price finally breaks free. This is why breakouts from well-formed boxes are often sharp and decisive. It is not coincidence. It is the release of accumulated orders, the sudden imbalance of supply and demand, the role of liquidity and order flow. Financial markets revolve around liquidity. Without liquidity, price cannot move efficiently. During the formation of a Darvas Box, liquidity becomes concentrated within a narrow range. Stop orders above and below the box represent pools of liquidity waiting to be triggered. Institutions seek these pools to enter or exit positions with minimal slippage. They may even manipulate price toward these areas to fill large orders. When price breaks through the boundaries of the Darvas Box, it taps into this liquidity, creating a surge in volume and momentum. This order flow dynamic explains why price often accelerates rapidly once the box is broken. It is not about technical analysis alone. It is about understanding where the orders are sitting and how the market structure facilitates their activation. Traders who recognize these dynamics can position themselves to ride the wave of liquidity. They do not need to predict the direction in advance. They simply need to observe where the market is gathering energy and prepare to act when the release comes. The power of simplicity and clarity. Another reason the Darvas Box is so effective is its simplicity. Unlike complex indicators that lag behind price, the Darvas Box is a real-time visual representation of market behavior. It shows you clearly where price is struggling and where it may find freedom. This clarity allows traders to build structured plans with defined entries, exits, and risk management parameters. Clarity breeds discipline. When you trade the Darvas Box, you know exactly where you are wrong. A return inside the box after a breakout invalidates the setup. This eliminates guesswork and emotional decision-making. It forces traders to operate within a framework of logic rather than impulse. Professional traders value this kind of structure. They understand that consistency comes not from prediction, but from managing risk and aligning with high probability scenarios. The Darvas Box provides both. Alignment with market cycles. Markets move in cycles: trends, consolidations, reversals. The Darvas Box aligns perfectly with these natural rhythms. It often forms at critical points in the cycle, either after a strong move as the market pauses to consolidate gains, or before a reversal, as buyers and sellers fight for control. Recognizing these phases helps traders understand where they are within the broader market context. Trading with the Darvas Box means trading in harmony with the market's natural behavior. You are not forcing trades in random conditions. You are waiting for the market to show you when it is ready to move. This patience aligns with the habits of professional traders who prioritize quality over quantity. Filtering out noise. Modern markets are filled with noise, false signals, random fluctuations, and short-term volatility designed to confuse and shake out the weak hands. The Darvas Box helps filter this noise. By focusing only on periods of clear consolidation and defined boundaries, traders can ignore the chaotic middle ground and concentrate on moments of genuine opportunity. When you trade the Darvas Box, you are not reacting to every price tick. You are observing structure, waiting for confirmation, and acting only when the market provides clarity. This approach reduces emotional trading, increases patience, and enhances focus. The balance between risk and reward. The Darvas Box offers one of the cleanest frameworks for managing risk. The boundaries of the box provide natural levels for stop-loss placement. You know that a valid breakout should not return inside the box. This allows for tight stops relative to the potential reward of a breakout move. The reward side is also clear. The size of the box often projects the minimum expected move, offering logical, objective targets. This favorable risk-to-reward ratio is what professional traders seek. They are not concerned with being right on every trade. They are concerned with ensuring that when they are right, the reward justifies the risk. The Darvas Box facilitates this mindset by offering structured, repeatable setups with defined parameters. Adaptability across markets and timeframes. One of the Darvas Box's greatest strengths is its adaptability. It works in all markets: forex, stocks, commodities, indices, and even cryptocurrencies. It functions across all timeframes, from intraday charts to weekly and monthly views. The underlying psychology of accumulation, distribution, and breakout remains constant because it is rooted in human behavior, not the specifics of any one asset class. This universality makes the Darvas Box a versatile tool for traders of all styles. Scalpers can use it on short time frames. Swing traders can apply it to daily charts. Position traders can leverage it on weekly charts. The principles remain unchanged. Confirmation through price action and volume. The Darvas Box does not operate in isolation. It integrates seamlessly with other tools of professional trading, such as price action analysis and volume studies. A breakout with strong volume confirms conviction. A retest of broken boundaries confirms structure. These additional layers of confirmation increase the probability of successful trades. By combining the Darvas Box with other forms of analysis, traders can build robust strategies that adapt to changing market conditions while maintaining consistency in execution. Teaching patience and discipline. Perhaps the greatest value of the Darvas Box is not technical, but psychological. It teaches traders the virtues of patience and discipline. The market does not reward impulsiveness. It rewards those who wait for the right moment, who understand the rhythm of price, and who respect structure over emotion. Trading the Darvas Box instills these habits. It forces you to observe, to wait, and to act only when conditions align. Over time, this cultivates the mindset of a professional, one who views trading not as gambling, but as a business of probabilities and process. Conclusion. The Darvas Box is effective because it captures the core dynamics of how markets operate: the battle between supply and demand, the buildup of energy, the release through breakout, and the constant interplay of fear and greed. It provides clarity, structure, and alignment with market cycles. It offers a framework for disciplined execution, logical risk management, and consistent opportunity. Those who master the Darvas Box are not merely drawing boxes on a chart. They are reading the silent conversations of the market, recognizing where liquidity hides, and positioning themselves to act when the market reveals its intentions. In this way, the Darvas Box becomes more than a tool. It becomes a lens through which to view and understand the deeper mechanics of price behavior, giving traders a durable edge in a world where most are lost in noise. Important considerations. When using the Darvas Box. The Darvas Box is a highly effective tool for reading market structure, capturing breakout opportunities, and filtering noise. However, like any method in trading, it is not infallible. Success with the Darvas Box requires more than simply drawing horizontal lines and waiting for price to break out. It demands an understanding of the nuances behind price behavior, risk management, and the psychology of market participants. To use the Darvas box properly and avoid common pitfalls, there are several key considerations you must always keep in mind. First, not every sideways market is a Darvas box. One of the most common mistakes among inexperienced traders is assuming that any period of sideways movement qualifies as a valid Darvas box. This is not true. A genuine Darvas box must have clear, well-defined boundaries created through multiple tests of both support and resistance. These boundaries reflect zones where both buyers and sellers are actively defending their positions. If price simply drifts sideways without clear reaction points or obvious defensive levels, it may be nothing more than temporary market noise rather than a true box. For a Darvas box to have meaning, the market must visibly respect its boundaries over time. Second, context is everything. A Darvas box does not exist in isolation. Its strength and significance are heavily influenced by where it forms within the broader market structure. A box forming after a strong uptrend may signal continuation. A box forming at the top of a parabolic move might signal exhaustion and distribution. Likewise, a box near the bottom of a long downtrend could hint at accumulation. Before trading any breakout, you must evaluate the higher timeframe trends, nearby key levels, and recent market sentiment. The best breakouts occur when the box aligns with the dominant direction of the larger market structure. Trading against this context often leads to false breakouts and frustration. Third, be wary of false breakouts and liquidity traps. False breakouts are a natural part of trading boxes. Markets are driven by liquidity, and large players often push price beyond the box boundaries to trigger stop losses and collect orders. After these traps are set, price often returns inside the box or even reverses entirely. Traders must develop patience and avoid reacting to the very first breakout candle. Look for confirmation through factors such as follow-through momentum, increased volume, or successful retests of the broken boundary. Entering too early without evidence increases the likelihood of being caught in a trap. Fourth, volume confirms the breakout. Volume is often the missing piece when evaluating a Darvas box breakout. A true breakout is usually accompanied by a noticeable increase in volume, reflecting institutional participation and the release of pent-up orders. If price breaks out on low volume with no clear momentum, the breakout is suspect. Without volume, there is often no conviction behind the move, and it is more likely to fail. Always monitor volume behavior as part of your confirmation checklist. Fifth, manage expectations about breakout strength. Not every breakout leads to a massive trend. Sometimes a breakout from a box results in a modest move before price returns to equilibrium. This is especially true in ranging or corrective markets, where overall direction is unclear. Avoid setting unrealistic targets based solely on the breakout. Use the size of the box, nearby support and resistance, and market structure to define realistic expectations. Some boxes will produce small gains, others large trends. Adapt your strategy accordingly. Sixth, size and duration matter. The larger and longer lasting a Darvas box, the more significant its breakout tends to be. A box that forms over several days or weeks on higher timeframes usually contains more accumulated orders and creates a more explosive move when broken. Conversely, small boxes on lower timeframes can still offer opportunities, but often produce more frequent false signals and require quicker management. Adjust your position size, targets, and expectations based on the time frame and scale of the box. Seventh, do not trade inside the box without a plan. Many traders grow impatient when price is stuck inside the box and attempt to scalp small moves between support and resistance. While possible, this approach requires precision and understanding that the edges of the box are often manipulated zones. Unless you are highly skilled at range trading, the safest opportunities come from trading the breakout. Trying to force trades within the box increases risk unnecessarily and often leads to frustration. Eighth, define clear entry, stop loss, and target rules. One of the strengths of the Darvas box is its ability to provide clear and objective levels for risk management. Stops should generally be placed just beyond the opposite boundary of the box. Entries should be based on confirmation, not guesses. Targets can be projected based on the height of the box or nearby key levels. Without predefined rules, traders tend to hesitate, enter late, exit early, or let emotions override logic. The Darvas box works best when paired with strict discipline and a well-defined process. Ninth, avoid overleveraging because the setup looks easy. The apparent clarity of a Darvas box often seduces traders into using excessive leverage. They believe the breakout is guaranteed. This is a dangerous mindset. Even the cleanest boxes can produce fake outs, reversals, and unexpected moves. Professional traders never bet big on a single setup, no matter how clear it appears. Always size positions based on acceptable risk levels, not the perceived certainty of the pattern. 10th, monitor broader market conditions. Certain market environments are more favorable for Darvas box trading than others. Trending markets with periods of healthy consolidation often produce clean breakouts. Choppy, low liquidity, or news-driven markets create more traps and false signals. Consider the volatility index, economic calendar, and broader sentiment before committing capital. Sometimes the best trade is no trade, especially when markets are unpredictable or lacking direction. 11th, accept that losses are part of the game. No setup is perfect. Even with the best boxes, well-placed stops, and proper confirmations, some trades will fail. Accept this as part of the trading business. The goal is not to win every trade, but to maintain a positive expectancy over time through disciplined execution. Losses from failed breakouts are normal and often quickly recovered by the next successful move. What matters is consistency, patience, and sticking to the process. 12th, keep a detailed trading journal. The Darvas box offers repeatable opportunities, but every market behaves slightly differently. Keeping a journal of your trades, including screenshots, entry reasons, outcomes, and observations, helps refine your approach. Reviewing past boxes, especially those that failed, teaches valuable lessons about context, timing, and confirmation. Over time, your pattern recognition sharpens and your decision-making becomes more precise. A practical example of the Darvas box in action. Understanding theory is important, but traders learn best by observing how a concept plays out in real market conditions. Below is a detailed example of how a Darvas box forms, how to interpret it correctly, and how to execute a trade around it with discipline, patience, and professionalism. Background of the market. Imagine you are analyzing a major forex currency pair, such as euro against the dollar, on the 4-hour chart. Prior to the Darvas box formation, price has been in a clear uptrend, consistently making higher highs and higher lows over several weeks. The most recent swing high touches 1.0900 before momentum begins to wane. Momentum indicators flatten and bullish candles begin to shrink in size. At this stage, price starts moving sideways between two clearly defined levels. The lower boundary around 1.0800 and the upper boundary near 1.0900. This sideways movement continues for nearly 2 weeks, forming what appears to be a textbook Darvas box, recognizing the box. Several characteristics validate this as a proper Darvas box. First, price tests both the upper and lower boundaries multiple times. There are at least 4 bounces from the lower level and 3 rejections from the upper level. These repeated touches confirm that buyers are defending the bottom while sellers are defending the top. Second, the candles inside the box become progressively smaller. Volatility compresses. Ranges tighten. This suggests indecision and a market in equilibrium. Third, volume gradually decreases throughout this period, reflecting lower participation as traders wait for a clearer direction. Fourth, the box forms after a clearly defined uptrend, which fits the common sequence of market behavior: impulse move, consolidation, and then potential continuation or reversal. Preparing the trade. With the box established, a disciplined trader avoids entering trades randomly within it. The plan is clear. Wait for a breakout with confirmation. 2 scenarios are prepared in advance. Scenario 1. A breakout above 1.0900 signals a bullish continuation. Scenario 2. A breakdown below 1.0800 signals a potential reversal or deeper correction. Pending orders are placed slightly beyond the box boundaries. A buy stop order is positioned at 1.0905, and a sell stop order is placed at 1.0795. Stop loss levels are set based on structure. For the buy order, the stop loss is placed just below 1.0800. For the sell order, it is placed just above 1.0900. Targets are projected using the height of the box. The distance between the two boundaries is approximately 100 pips. Therefore, upon breakout, the projected target is at least 100 pips from the breakout point. Execution of the breakout. Several days later, the breakout materializes. Price surges through 1.0900 with a strong bullish candle that closes above this level. Volume spikes noticeably, confirming increased participation. The buy stop order is triggered at 1.0905. The market briefly retests the breakout zone, dipping to 1.0900 before rebounding strongly. This retest serves as additional confirmation that former resistance has now turned into support. Within 48 hours, price rallies to 1.1000, hitting the projected target. The trader exits the position with a solid profit, having followed the trading plan from start to finish, without hesitation or emotional interference. Key lessons from this example. Patience is rewarded. The trader did not attempt to predict direction or force trades within the box. Instead, they waited for the market to reveal its hand. Clear structure simplifies decisions. The Darvas box provided well-defined levels for entry, stop loss, and take profit. There was no guesswork involved. Volume offered crucial confirmation. The breakout was accompanied by increased volume, suggesting genuine interest and reducing the chance of a false move. Risk management was respected. The stop loss was logical and aligned with the box's technical boundaries. Position size was calculated according to risk tolerance. Psychology matters. The trader trusted the process, stayed disciplined, and avoided chasing price or reacting emotionally to market noise, applying the Darvas box across markets. Although this example focused on a forex pair using the 4-hour chart, the principles are universal. Stocks, commodities, indices, and cryptocurrencies all exhibit similar behavior. Trends followed by consolidations, then breakouts. The Darvas box can be used on intraday, daily, or even weekly charts. The key lies in understanding the underlying psychology. Consolidation represents preparation, and breakout represents opportunity. Structure provides clarity. Discipline ensures execution. Conclusion. This real-world example illustrates why the Darvas box remains a favored tool among experienced traders. It offers a simple yet powerful framework to interpret price action, develop a trade plan, and manage risk in harmony with market behavior. When combined with patience, market observation, and disciplined execution, the Darvas box becomes more than just a setup. It becomes a cornerstone of professional trading. Advantages and disadvantages of the Darvas box. The Darvas box is not a perfect or magical method, but it remains a favored tool among professional traders because of its clarity, structure, and the way it reflects the psychological equilibrium between buyers and sellers. Understanding both the strengths and weaknesses of the Darvas box is essential if you want to apply it effectively across different markets and timeframes. Advantages of the Darvas box. First, easy to recognize and highly visual. The Darvas box is a market structure pattern that is simple to recognize for anyone familiar with price charts. You only need to observe a period where price moves sideways within well-defined boundaries of support and resistance. No complicated indicators are required. The Darvas box is built solely on pure price action. This simplicity helps traders maintain a clean and objective trading approach. Second, clear and precise risk management. One of the greatest strengths of the Darvas box is how naturally it offers clear areas for stop-loss placement. If you buy on a breakout above resistance, your stop-loss logically sits just below the lower boundary of the box. If you sell on a breakdown below support, your stop-loss is placed just above the upper boundary. This structure helps you define your risk precisely and eliminates emotional decision-making. Third, encourages patience and discipline. The Darvas box requires patience from the trader. You are not taking random trades, and you are not participating inside the range unless specifically planned. You only act when the market gives a clear breakout or breakdown. This structure forces you to avoid overtrading and strengthens long-term consistency. Fourth, accurately reflects market psychology. The Darvas Box visually captures the psychology of the market. When price moves sideways, it reflects indecision, accumulation, or distribution between buyers and sellers. A breakout reveals that one side has gained control and the market is ready for its next phase. Understanding this dynamic gives you an edge in reading price behavior more accurately. Fifth, applicable across all markets and timeframes. Whether you trade Forex, stocks, commodities, indices, or cryptocurrencies, the Darvas Box remains relevant. It works on 5-minute charts, 15-minute charts, daily charts, and even weekly charts. Market psychology does not change from asset to asset. This makes the Darvas Box a flexible tool that adapts to many trading strategies. Sixth, fits all trading styles. Whether you are a scalper, a swing trader, or a position trader, the Darvas Box can serve your needs. Short-term traders can look for quick breakouts on lower time frames. Long-term traders can wait for boxes that form over days or weeks to capture larger moves. The principles remain consistent across styles. Disadvantages of the Darvas Box. First, vulnerable to false breakouts. The Darvas Box often attracts a large number of breakout orders at both boundaries. This invites institutional players to create false breakouts, triggering stops and collecting liquidity before reversing the market. Inexperienced traders who do not wait for sufficient confirmation are especially vulnerable to this common trap. Second, less effective in choppy or wide-ranging markets. When the market lacks clear trends or enters broad sideways phases, the Darvas Box may lose its clarity. Violent whipsaws within the range can produce multiple false signals, leading to consecutive small losses and trader frustration. Third, requires a high level of patience. If you are the type of trader who needs to take trades every day, the Darvas Box may not suit you. It often requires waiting for an extended period until the box forms properly and provides a valid breakout. This patience can be challenging for impulsive traders. Fourth, works best when combined with additional confirmation. The Darvas Box provides accumulation and breakout zones, but it is not enough on its own. Combining it with other tools such as volume analysis, candlestick confirmation, higher time frame trends, or market sentiment can significantly improve success rates. Failing to do so may lead to confusion between real and false breakouts. Fifth, less reliable during major news or high volatility events. Markets driven by unexpected news often break out of boxes in unpredictable ways. These breakouts may lack retests or produce erratic price action. Using the Darvas Box during such periods without adjustment often leads to reduced effectiveness. Conclusion. The Darvas Box is a simple yet powerful tool when understood and applied correctly. It offers clear risk management, structured trading plans, and aligns closely with market psychology. However, it is not a shortcut to easy profits. Traders must respect its limitations, avoid assuming every breakout will succeed, and always combine it with solid risk management and additional confirmation tools. When used with discipline, patience, and professionalism, the Darvas Box becomes a reliable weapon for navigating the complexities of the financial markets. Conclusion. The Darvas Box is a professional-level trading tool, but it only delivers consistent results when applied with wisdom, patience, and a deep respect for the market's complexity. It offers structure, clarity, and logical points for both entry and exit. However, its effectiveness ultimately depends on your ability to interpret the broader market context, manage risk with precision, and maintain emotional discipline. Trading the Darvas Box is not about predicting the market. It is about aligning yourself with the natural rhythms of accumulation, consolidation, and breakout. When used properly, the Darvas Box becomes one of the most dependable frameworks for capturing clean, high-probability movements across any asset class or time frame.